So what is our investment philosophy? This is the way I like to describe it. Number one, we love diversification. Diversification is what protects our clients from companies like Enron and from countries like Greece. Simply owning a very broadly diversified portfolio helps to immunize you from events like that, interfering with you and your progress. Beyond that, though, I like to start with what we call the global opportunity set. Those are the 15,000 some odd publicly traded equities that you find around the world. If you simply buy them and hold them over time, you seem to get about 10% per year, which is better than most people achieve investing. But there are some things we know about the companies within there that allow us to focus our clients' capital on the opportunities that have the best expected outcomes. What we know is that small companies outperform large companies, cheap companies outperform expensive companies, and more profitable companies, holding price constant, have better returns than less profitable companies. So we use an algorithm that takes a look at the securities that the client owns every day to make sure that their capital is focused on the companies that have the best expected outcome, while striking a balance against our desire to be diversified. On the fixed income or bond side, there are really two kinds of risk in bonds. There's default risk, the risk that the companies you loan the money to don't pay you back, and there's term risk, or the risk that inflation is higher than you want it to be. The way we view fixed income in our portfolios, that is the role of fixed income, is to be there for our clients during times like 2008. We want it to be a cushion in really rough times, a place where they can count on their portfolio to create income or stability, or give them the ability to sleep at night. So we don't want default risk in the portfolio. So we own many bonds, and the bonds are high quality, AA rated or better. We're also diversified, just like on the equity side, with a global bond portfolio. And we don't really like the increased return you get when you take term risk. So the bonds are short term. Our bond portfolios are very stable during times like 2008. When you combine the equity portfolio with the bond portfolio, it allows us to form different plots on the risk spectrum, which allow us to identify our clients' needs and get them in a portfolio that will get them where they want to go.